Good afternoon, everyone. We're just waiting on people to join. Give us just a few more seconds and we'll get started. Okay, we will get going. Good afternoon, everyone. Again, my name is Josh Strittmatter, and I'd like to welcome you to Strittmatter Wealth Smart Money Webinar Series. Thank you for joining us. Our presentation today is titled The Growing U.S.-China Rift, Implications for Investors. For those of you that don't know us, well, there we go. We are Strittmatter Wealth Management Group, a registered investment advisor located in downtown Fort Worth. We specialize in investment management, financial planning, estate planning, and real estate investing. We've been in business since 2007 and serve clients throughout the United States. A little bit of housekeeping before we get started. All of you have access to the chat feature, so that if you have any questions, please don't hesitate to type those in, and we'll be happy to answer those for you. Also, we'll be sending out a replay of today's webinar via email, so if you missed something, don't panic. You'll have the ability to watch this again, and you are welcome to forward these presentations and any of our presentations to your friends and family if you think it would be beneficial. Today's webinar is meant to be purely educational rather, and not meant as tax or legal advice. Please talk to your licensed professional before taking any action on any of the information in this presentation. For more information, including key disclosures, please visit our website at strittmatterwealth.com. And finally, let me introduce our speaker today. Patrick Fearon-Hernandez is Chief Market Strategist for Confluence Investment Management, where he analyzes financial market trends, global economics, and geopolitical developments, including international security issues, in order to map their implications on investment strategy. He has worked in a wide variety of investment roles over his career. His early career experience began at the North Atlantic Treaty Organization in Brussels, Belgium, and at the Central Intelligence Agency in Washington, D.C. So without further ado, I'm going to hand it off to Mark. Good afternoon, Mark. How are you?
Well, good afternoon. I'm not sure if I've got this properly shared. Have you seen my slides? Or
Nope, just click on the share button there, and you should be able to share your presentation.
Okay, I see. Sorry about that. All right. All right, very good. Well, sorry about the snafu there, but yeah, thank you so much, Josh, and thanks to everyone at Strittmatter and all of your guests today. We at Confluence, we really appreciate the opportunity to share our ideas, and just as important also to hear people's feedback and questions and concerns or criticisms even. That just makes us better analysts, and so hopefully we'll have time for a bit of Q&A at the very end. Now, I think one thing that makes us a little bit different at Confluence is that we have this macro analysis group, which I head up, which focuses very heavily on big global trends in geopolitics and economics and trade, demographics, even social trends, in order to understand what are the big investable global megatrends out there. And once we identify those trends, we first of all look for ways to minimize any risks associated with them, but then also to figure out how we can take advantage of them. And then we put those ideas into practice in our various portfolios and strategies, for example, in our asset allocation portfolios. Now, among the different global megatrends out there, we think one of the most important is the growing rift between the US and China. And so that's what I'm going to focus on here today. In particular, what I'll be talking about is, first of all, what do US and Chinese leaders want? Next, I'll say a word or two about how China is deliberately and actively building up its global power. I'll say some words about how China's rise is actually fracturing the world into different camps or blocks. And then I'll end up with a little bit of discussion of economic and investment implications. Now, in terms of what US and Chinese leaders want, first of all, it's important to remember that in those years right after World War II, US leaders were desperate to figure out a way to avoid another global conflict. And so they ultimately decided that the US should take on the role as the global hegemon. So in other words, the big, strong, dominant country that provides international security and stability and many aspects of international law, and in general, just the order that makes the world work better. As part of our strategy to be the global hegemon, we also decided to provide the world's reserve currency, the dollar, which we did mostly through maintaining ourselves open to international trade and capital flows. Now, the problem is that the policies that supported the US role as global hegemon were actually pretty costly and are still pretty costly. In terms of military activity, for example, many relatively small but long-lasting bloody wars in places like Iraq and Afghanistan and Vietnam. Maintaining ourselves open to trade meant that our manufacturers were subjected to intense competition from low-cost foreign producers, and a lot of our factories moved overseas. And all these costs are a reason why you're starting to see more and more populism in the US and this America First sentiment. The key thing is that this hesitancy about staying the global hegemon has given the foreign authoritarian powers an incentive to assert themselves. And the most important of those powers is China. Now, what China, and in particular the Chinese Communist Party, want is pretty evident both in their public and private pronunciations and documents, etc. What the Chinese Communist Party is looking for is what they call the great rejuvenation of the Chinese people by 2049. Now, what they mean by that is they want China to reclaim its traditional historical role as the world's greatest military power and economic power and even cultural power. What that also implies is that China would have to consolidate its control over disputed territories along its periphery, most importantly Taiwan, but also the broader South China Sea and the East China Sea and areas in the Himalayas. Now, in order for them to achieve this, they need to aggressively reorder the global order. Now, how are they building their power to do that? There's actually several different aspects, and I'm only going to focus really on two in particular. First of all, Chinese economic power. Now, as China opened up and reformed beginning in the late 1980s and 90s, what they were able to offer to foreigners is this prospect that their enormous population, which was going to get richer and richer, and their economy that was going to grow so much, would be a place where foreign countries could export, and also where foreign companies could come and set up shop and have access to this enormous, fast-growing market. In this chart, as one example of that, I'm showing the overall level of US imports over time in the blue line. And then the red line represents Chinese imports over the last 30 years or so. And you can see that Chinese imports were growing about twice as fast as US imports. Now, if you look at the far right side of the chart, however, you see that Chinese imports really have dropped off over the last few years and now are kind of stagnant. That has some big implications going forward. Now, first of all, another thing that I want to mention is that despite that growth in Chinese imports, it's easy to overstate China's economic power. As one example of that, in this chart, I'm showing total Chinese imports and then total US imports. And the light colored parts of these bars show service imports. The rest of it is goods imports. And so you can see that Chinese imports in 2019, and I use that year simply because that was the last year before the disruptions of the coronavirus pandemic, but they were importing about $2.5 trillion worth of goods and services in that year. Look at the US. We were importing more than 3 trillion. Now, what that reflects is that the US actually is more important to the international economy than you might think. You can also look at that in terms of how important those exports are to the exporting countries' economies. So the red bar here shows that for the typical country exporting to China, those exports made up about 2.8% of their economy. Look at for the US, the typical country exporting to the US gets about 4%, almost 4% of its economy from exporting to the United States. So the US still has an awful lot of sway economically, probably more than a lot of people realize. If you look at it in terms of capital flows, it's a similar story. For foreign direct investment, the bulk of it comes from the US compared with China. Same thing with portfolio investment. There was a period where Chinese bank lending was especially strong, but if I now updated this chart to show the last couple of years, the disparity between the US and China is a lot less. Now, I mentioned that Chinese imports have really slowed in recent years. Part of what's driving that, the bulk of what's driving that, is that the Chinese economy is now running up against some really serious structural headwinds, which we call the 5Ds. So weak consumer demand, in addition, excess capacity and problematic debt levels. They have really poor demographics. There's foreign decoupling as other countries pull back from international trade and capital and technology flows with China. And then finally, you have big disincentives as the Communist Party inserts the government more and more into the Chinese economy. So the Chinese economy may be slowing and plateauing, but that doesn't necessarily mean that China is giving up on increasing its power. Actually, they're still growing their military power pretty dramatically, and that's actually becoming the bigger story. Now, I'm oriented toward defense economics, and so everything between the interplay between the economy and the military and vice versa. So I pay a lot of attention to the level of resources that are channeled into a military. In this chart, the blue line shows total US defense spending over the century so far. As you can see, pretty strong upward trend, definitely some ups and downs, mostly related to the ebb and flow of wars in Iraq and Afghanistan, but clearly an upward trend, leading to about $825 billion worth of spending in 2023. The red line at the bottom shows total Chinese defense spending as estimated by a well-respected think tank out of Europe. Now, the problem with that red line is that it doesn't capture all of the distortions and subsidies and pricing anomalies that are still prevalent in the Chinese economy. So that gray line in the middle is my effort to correct for at least the pricing disparities using an economic analysis tool called purchasing power parity. If you use that measure, China was spending about $500 billion on defense in 2023. Now, remember, as I mentioned, the US is still the global hegemon. And so if you think about it, what that means is that our defense sphere is basically the whole world. So if you take that $825 billion that we spent in 2023, and divide it by the square mileage of the Earth's surface, and let's exclude Antarctica, which is nominally neutral, we were spending about $4,300 for every square mile of the Earth's surface in that year. So $4,300 for every square mile of the US, of Australia, of Colombia, of the South China Sea, of the Atlantic Ocean. if you look at that $500 million or $500 billion or so for China, you know, they ultimately want to displace us as the global hegemon, but as of right now, they're still pretty much a regional power. Let's say that their defense sphere is still maybe the eastern half of the northern hemisphere, so about a quarter of the Earth's surface. Well, if you take their spending in 2023 and divide it by that square mileage, they were spending almost $11,000 for every square mile of their defense sphere. And I think that really is telling about the level of resources that they're putting into their military. Now, China's Navy is especially important to them, especially given that they have such a strong desire to take over Taiwan and assert their sovereignty over the South China Sea and the East China Sea. The naval area is the area where you'd most likely see a conflict between China and the US someday. Now, China actually has the world's largest navy already, depending on how you count it, between 370 and about 400 combat ships. That compares with about 295 combat ships for the US. Now, in this chart, I'm comparing the number of vessels between the US and China by major category. And I've arrayed it so that the larger, more capable vessels are on the left, and then the smaller and less capable ones are on the right. So if you look at the aircraft carriers, the cruisers, the destroyers, in other words, the big blue water Navy ships that allow a country to project power all over the world, that's still dominated by the US. We have many more resources of that type than China does. You can say the same thing about the ballistic missile subs, the nuclear attack subs. But then if you look at the smaller, less capable vessels like the frigates, the corvettes, the diesel electric subs, coastal patrol, and amphibious, China is by far the bigger player. And what that represents is a very specific strategy that China is still pursuing as of right now. That strategy is called anti-access area denial. So what they're trying to do, even though off in the future they want to be a global power and project power globally, right now their focus is on being able to saturate the waters around China's coast to the point where they could deny the US Navy access and prevent the US from intervening if they ever want to take over Taiwan or islands in the South China Sea, etc. So anti-access area denial. So that's a key reason why you're seeing this disparity in the different types of vessels. Now, it's easy to think that China's Navy is made up of these ancient rust buckets from the 60s or 70s. I like to use this slide to show that that simply is not the case. These are very often modern, quite new, quite capable multi-role vessels with advanced weapons, advanced sensors. A key thing that you might want to look at is those two carriers up at the top. The Shandong on the left is China's second aircraft carrier, uses really old technology. You'll see the ski jump bow in the front there that helps airplanes get up in the air. The Fujian to the right is their newest carrier, their first domestically designed and built carrier. And you notice it has the flat deck. It looks much more modern. It has electromagnetic catapults, just like the latest US carriers. And so again, just showing that these are actually quite capable ships. Let's turn to air power. Kind of a similar story. If you look at the fighters, bombers, transports, helicopters, even the longer range ballistic missiles that carry nuclear weapons, the US still dominates China pretty dramatically in those areas. But look at the shorter range, the intermediate range, the medium range, the short range ballistic missiles. That is all still dominated by China. And largely that reflects the arms control treaties of World War II that prevented of the Cold War, that prevented the US from fielding those types of missiles. Now, those arms control treaties have gone away, and so the US is starting to develop its arsenal of those missiles again. But as of right now, we're way behind. In terms of air power, just wanted to give you a sense of what Chinese assets look like. Also like the idea that this has a picture of an F-16, so a nice Fort Worth product. Beyond that, look at those fighters. Gee, they look a lot like US fighters, don't they? I imagine you all have a pretty good idea of why that is the case. Now, turning back to the missiles, I'd like to use this map to show just how big of a threat that is. The dark red area shows the coverage just from China's short-range missiles. And you see that those missiles alone can cover basically all of Japan, all of the Koreas, Vietnam, the northern Philippines, and of course, Taiwan. If you look at the longer range missiles, they have the ability to saturate the waters well out into the Western Pacific. So what this means is that even if the US were able to sink every single Chinese Navy ship in a conflict, we'd still have to deal with this intense missile threat. And to take out those missiles, we would have to attack China's mainland itself. And you can imagine the consequences that would bring. So again, this is a part of China's current anti-access area denial strategy. Now, let's turn really quickly to China's long-range missiles carrying nuclear weapons. For many decades, China maintained just a minimal arsenal of about 200 warheads. But in recent years, they have clearly decided to revamp that strategy and move to a position where it looks like they're trying to match the US number of deployed nuclear weapons. We have almost 1,800 of those weapons deployed right now. It looks like China is on track to catch us sometime in the mid-2030s. This has big implications for international security and for commodity markets, believe it or not, and I'll touch on that a little bit later. So with the way that China's economic rise and then now its military rise is progressing and really capturing the attention of the US and its allies, what we believe is that what's happening is that as countries respond to China's rise, they're coalescing into relatively separate geopolitical and economic blocs or camps. When we started to see this trend over the last few years, we decided to come up with a methodology that we thought would be quite objective and quantitative and defensible to determine or to guess where about 200 countries around the world would end up in terms of the different blocks. And I won't get into the actual methodology, but I use this chart to give a sense of what our methodology tells us about how these blocks are evolving. Now, I can't show all 200 countries that we applied this to. The font would be way too small to read, but this is a set of representative samples. Now, if you look at the far left side, at the evolving US-led bloc, you see the US, the UK, Canada, Italy, Poland, Israel, Australia, South Korea, Mexico. The evolving US bloc is basically today's advanced, highly industrialized, rich liberal democracies and a few closely related emerging markets. Now look at the far right side, the China-led bloc. So China, Russia, Iran, Iraq, Tajikistan, Pakistan, Congo, Venezuela. It's a dramatically different group. First of all, they are all emerging markets or frontier markets. They're also largely authoritarian run. And then just as important as anything, they're all big commodity producers or dependent on commodity production. That has some really big implications that I'll touch on in a moment. Let's look at this from a couple of other perspectives. First of all, in terms of global population. From this perspective, it looks like the China bloc and the China leaning bloc are in the driver's seat. Together, they make up about 2/3 of the world's population. However, if you look at it in terms of economic output, it's a much different story. The US bloc and the US leaning bloc alone make up about 2/3 of the global economy. Another aspect of that, if you look at GDP per capita, look at this. For the US bloc alone, on average, our GDP, which is another way of getting at relative income levels, look at this, in 2021, almost $45,000 per capita. Now look at the China bloc, only about 15,000. Big difference. If you look at it in terms of international trade, as you might expect, because the US bloc is so rich, that's where exporters around the world want to sell into. Now, in this chart, the blue columns show how much US exporters are sending to the different blocs. As you can see, the US exporters typically have sent about $1.2 trillion worth of goods to the rest of our bloc. Look at for China. Chinese exporters have typically in recent years been sending about $1.6 trillion to our bloc. It's far more than they send to other blocs. If you look at how important those exports are to the exporting economy, it's a similar story. So here what you're seeing is that for the US, our exports to the rest of our bloc account for about 5.8% of our economy. Look at this for China. China's exports to the overall US bloc make up about 1/9 of the Chinese economy. So when you see this chart, what I always tell people is there's one word that should jump to mind, and that word is dependency. China is very dependent on selling into the overall US bloc. And this is exactly why, back starting about 8 or 10 years ago, as US leaders started to understand the growing threat from China, this is why the Trump administration imposed all these big tariffs and other trade barriers to China to prevent it from selling so much into our bloc. We recognize that this was our leverage over China. And a lot of people thought that when the Biden administration would come in, that they would dismantle those tariffs and trade barriers, and they haven't. And I think that reflects the wide bipartisan recognition now, not only of the fact that China is a threat, but we need to do something about it, and economic barriers is one part of it. Now, that's not the only part. In terms of where we can really have leverage over China, technology is also a big part of it. So in this chart, what I'm showing is the overall trade balance just for semiconductors among the different blocs. So as you can see on the left, the US bloc as a whole has a pretty hefty trade surplus in semiconductors. Look at the China bloc. They typically have a big trade deficit in semiconductors. They're very dependent on the US bloc's technology. And so this is why the Biden administration not only kept on the big trade barriers, the broad trade barriers to China, but also in October 22, imposed really dramatic clampdowns on sending US advanced semiconductors to China. Not only did they block sending US semiconductors or semiconductors with advanced US technology, but also the equipment to manufacture those semiconductors, even the services to service the machinery to make those semiconductors. A very draconian move against China, because we recognize that this is a key source of leverage that we have to prevent their military, or at least slow their military growth, and help preserve the privileges of US hegemony and the freedom of the US bloc. Now, how are the Chinese going to respond to these trade and technology barriers that we've put up against them? And by the way, I note that it's not just the US that has realized that we need to do this, but now even the Europeans and our Asian allies have started to impose similar trade and investment and technology barriers to China. Well, we don't think the Chinese are going to just roll over and play dead. We think that they're going to respond. The question is how? We think a key way that they're going to respond is by weaponizing those commodity products that they dominate. Now, they don't dominate every type of commodity. For example, iron ore or something like that is widely distributed throughout the Earth's crust. And so they can't really leverage those or weaponize those against us. However, there are some very important mineral commodities that they can work against us. So rare earths are a great example. Now, as you may know, rare earths are a type of mineral that are that's very important to the growing electrified economy of the future. In this chart, the purple bars show proven reserves of rare earths by the different blocks. The green bars show actual production. And you can see that the bulk of the reserves, the bulk of the production, if I could show refining capacity, that's also heavily focused on the China bloc. And so this is the type of product that we think over time the Chinese will threaten to cut off from the US and the rest of our bloc. And indeed, they're already showing signs that they're preparing to do that. Another potential way or another potential commodity where they would try to hurt us like that is crude oil. Here, the black bars show reserves, the green bars show production, and the red bars show consumption. And so you can see that, again, the China bloc has the bulk of the world's reserves, bulk of the world's production, and they use a lot less than they produce. So that gives them leverage. Very similar story with natural gas. Now, if you have any doubts that they would actually weaponize these commodities, like I'm saying, I would remind you that this is exactly why the Russians cut off natural gas supplies to Western Europe in 2022 in order to punish the Western Europeans for supporting Ukraine after Russia had invaded. They cut off the Western European supplies of natural gas in large part. We think a similar risk is out there going forward as the tensions between the US bloc and the China bloc intensify. I'll say a quick word or two about uranium. Now here, it looks like the bulk of the world's reserves are in the US bloc. However, here I've divided the reserves by how expensive or how easy it is to produce the different reserves. And what I'm showing with the dark blue areas, those are the very cheapest uranium resources, and you can see that the bulk of those are in the China bloc. If you look at the US bloc, most of our uranium reserves are much more expensive to extract. Now, the reason I talk about this, there's actually a couple of reasons. First of all, the global analysts have recently realized that going forward, China in particular, but also India and some other countries really intend to ramp up dramatically their use of nuclear energy to generate electricity. And so the expectation is that uranium demand is going to climb at a pretty good clip in future years. In this chart, I'm showing with the black line the expected growth in uranium demand for electricity generation. The columns there show current and expected mine output, the output from uranium mines over time. And you can see that there's a big expectation that the demand is going to outstrip output in the future, and the shortfall is shown in the tan area here. But what I want to emphasize is that, as I said earlier, the way that the Chinese are rapidly increasing their arsenal of nuclear weapons is going to be a big additional incremental source of demand for uranium. And we think that's going to have some big impacts going forward. Now, just the increase in demand and the expectation for future shortfalls alone has really driven up spot uranium prices in recent years. A lot of people are only focused on that electricity demand. One of the things that I think is very cutting edge here for us at Confluence is really scoping out that additional demand that you're likely to get as China builds out its nuclear weapons portfolio. We think that is going to really bolster uranium prices going forward. And so this is one example of how our analysis has an impact in our thinking about investment strategy going forward. So what are the economic and investment implications of what I've been talking about? First of all, in terms of corporate strategy, we're seeing a lot more nearshoring, friendshoring, in other words, bringing production and investment back home to the US, or at least to friendly countries. We're seeing companies using a lot more or building a lot more spare capacity and having higher inventories. Basically anything you can do to improve corporate resilience, as opposed to the almost exclusive focus on efficiency that we saw during the globalization period after the end of the Cold War. In terms of macroeconomic implications, we think what we're going to see is higher investment needs, whether it's corporate or government, defense industry, military. We think we're going to see stronger state intervention in the economy, higher production costs, probably lower margins for companies. And very importantly, we think we're going into a period of higher and more volatile inflation than we saw over the last 30 years. And by implication, then higher and more volatile interest rates, although there's also a risk of what we call financial repression. And I'll say a word about that in a moment. Just to flesh out some of these ideas, I mentioned the greater investment as the US and the rest of our bloc reindustrializes in response to these trends. In this chart, the blue line shows total non-residential, in other words, corporate private construction over time. The red line shows the dollars spent on constructing new manufacturing facilities. And you can see that that's primarily driven these days by new factories in computers and electronics and electrical types of things. So electric vehicles, batteries, solar cells, semiconductors, and things like that. Now, one thing that we really think is going to happen as these international tensions continue, and you see this fracturing of the world into different blocks, is that defense spending is going to go up. To scope out how that's going to look, there's a lot of people who agree with us now, and they do think that defense spending is going to go up. And they say, well, the US and our allies are going to have to either increase taxes or cut civilian spending in order for that to happen. In order to see if that's really true, we did an analysis recently where we looked at how the federal budget has changed in recent years versus the way it looked back at the last period of great power competition at the end of the Cold War. So in this chart, I'm showing all the major federal budget categories for revenues and outlays as a share of GDP. The blue columns show the share of GDP back at the end of the Cold War. The red columns show the share of GDP in 2023. If you look about 2/3 of the way off to the right side of the chart for defense outlays, you can see that what we did after the Cold War is we slashed defense spending. But if you look right in the middle of the chart, in order to figure out where we spent those savings, it's pretty clear that we took them and we channeled them into Social Security, Medicare, Medicaid, and other healthcare outlays, basically. Basically, that's it. The story of how we rejiggered our budget after the Cold War is that we slashed defense spending and channeled it toward things that help older people. End of story. Now, the thing is that older people are politically more powerful. And so the idea that we're going to cut civilian spending in order to fund higher defense spending doesn't seem politically likely to us. We actually think that there's a good chance that as the US and our allies respond to these tensions and rebuild our defense and increase our defense outlays, it's going to mean that the federal budget deficit is likely to stay very high and, in fact, even increase. Now, how is that going to play out? Well, you can see in this chart that it's already happening. The red line here shows total federal outlays. The blue line shows revenues. And anytime you see that that difference or that disparity is increasing, that's a sign that the deficit is going up. And you can see that's actually happening right now. Now, what we think is going to happen, or at least there's a big risk of it happening, is that the federal government will ultimately artificially hold down long-term interest rates, which we call financial repression. And that's a big risk, and it has some big implications for fixed income investors going forward. So in terms of overall investment implications, and then I'll wrap this up, we think that the standard portfolio that we all have thought about over the last few decades of 60% stocks and 40% bonds might need to be adjusted going forward. We do still think that equities are likely to provide the best total returns. However, fixed income is likely to be challenged in part because of the high inflation, the high interest rates that I mentioned before, but also that risk of financial repression where the government could hold down bond yields to the point where investors aren't being compensated for the higher level of inflation that we're going to see going forward. Now, we do think that commodities offer the other extreme of probably good returns. Geopolitical tensions typically are good for commodities, but also higher inflation or a higher inflation environment tends to be good. In terms of most favored assets, we like, first of all, short-term assets, so not just short-term bonds, but also dividend-paying stocks. We like industrials, especially defense. We like basic materials, energy. And then when it comes to specific commodities, we like minerals. We like precious metals, uranium, oil, and gas in particular. No financial presentation is complete without some disclosures. Thankfully, I don't have to go through this in detail. And finally, I just want to mention that we put out an awful lot of thought leadership pieces, written and audio. You can find us on the internet. You see here our website as well as our X or Twitter location, and we're also on LinkedIn. And we do invite you to pay close attention to what we're saying out on the internet, and you can always follow what our thinking is. So that wraps up my very quick presentation. Hopefully, we have time for a little bit of Q&A if possible.
All right, Patrick, thank you very much. Great presentation. Lots of good information about China. And if any of you have any questions, please type it into the chat feature. Should be working for you. I'm going to commandeer our screen back. Give me one moment here. And I've got a couple of questions that I'll ask of you, Patrick. All right. So kind of some overarching things here are that China is not as big a problem as as the media makes them out to be, in terms of taking over the world currency, the world economy. They obviously have a lot of the exports coming out of there, and I think we're mutually dependent upon them as well. But I think some of the takeaways are that commodity prices are being driven by some of the things that they're doing right now, and that might be an opportunity on the investment side as well. I also know that China is kind of on the upswing right now. It's been in a pretty big bear market for the last year or so, and we're starting to see a recovery there. I think I was looking at the FXI index, China large cap companies a couple days ago, and I think it was up something like 20% year to date. So they have a turnaround story happening right now. Do you have any comments on that?
Yeah, certainly it's true that in the short term, we're seeing a little bit of a rebound, both in terms of actual economic activity and then, as you mentioned, the financial markets. Part of that is that the Chinese government has gotten a little bit scared about slower economic growth, and so they've implemented some what I would call fairly modest stimulus measures. It's not entirely sure that how much that's going to help. But nevertheless, looking forward, these big structural issues, like I said, the 5Ds, the weak consumer demand, the excess debt, the demographics, et cetera, that's really going to hold down Chinese economic growth going forward. And so that's why that's a key reason why I think that the story for the future is going to be that they're actually increasing their military power more than their economic power. I'll also make one quick note on their financial strategy, the financial market strategy. They've said recently that their goal, the Communist Party's goal, is to make China a financial superpower. Now, that sounds pretty weird, pretty ambitious, given all their capital controls and the way that the Communist Party intrudes into the markets. It'll be hard for them to really grow their reputation as a good place to do financial business. But nevertheless, they're going to try, and they're going to pour money into it and artificially support their markets. There's a lot of Western and especially US financial firms that think their future is in their business in China. And I think that China's new strategy to become a financial superpower is probably going to be a negative for US financial firms and maybe undermine some of their support for maintaining trade and relations with China. In fact, I saw in the press just today that JP Morgan CEO Diamond recently told the group that some of their business in China has already fallen off a cliff. So a thing to watch going forward.
Interesting. Yeah, these are definitely some interesting times. And, China's obviously in the news almost every day. So this is all great information. I don't have any questions from the audience. And in the interest of time, I'm going to wrap this up. But Patrick, thank you so much for your time today. Great information. Thoroughly enjoyed it. Look forward to seeing you again in the future.
I appreciate it. Thanks for the opportunity.
All righty. Thanks. Bye-bye.
Bye.